Imagine a time when a single flower bulb could cost more than a house. This isn't a fantasy story. It's the tale of Tulipmania, the first recorded economic bubble in history, a wild chapter from the 1600s Dutch Golden Age. Tulips, originally from the Ottoman Empire, arrived in the Netherlands and quickly became a symbol of wealth and status. Their vibrant, exotic petals were unlike anything the Dutch had ever seen. Initially, they were a luxury item for the wealthy elite and botanists who cherished their rarity and beauty. But soon, something shifted. The fascination turned into a frenzy. The prices for rare tulip bulbs began to climb, and then they skyrocketed. People from all walks of life, from merchants to maids, wanted in on the action. They saw their neighbors getting rich overnight simply by trading these colorful bulbs. The fear of missing out, or FOMO as we'd call it today, took hold of the entire nation. It became a speculative market, where the price of tulips had nothing to do with their actual value as flowers. People weren't buying them to plant in their gardens, they were buying them with the sole intention of selling them for a higher price. Contracts for bulbs were traded in taverns, sometimes for bulbs that hadn't even been harvested yet. This was an early form of futures trading, driven by pure speculation and the belief that prices would continue to rise forever. A single bulb of a rare variety like the Semper Augustus, famous for its stunning red and white flame-like patterns, could be traded for the price of a grand Amsterdam estate. People traded their life savings, their businesses, and their land for a chance to profit from the tulip craze. The market was fueled by pure emotion, a collective belief that the prices could only go up. This is a classic sign of an economic bubble. The price of an asset detaches completely from its intrinsic value, propelled instead by psychological factors like greed and herd mentality. Everyone believed they were a genius, that they had discovered the secret to easy wealth. But the foundation of this market was built on sand. Then, in the winter of 1637, the inevitable happened. The bubble burst. It started slowly. A few savvy investors decided the prices were absurdly high and decided to cash out. When buyers at a routine bulb auction failed to show up, panic began to ripple through the market. Confidence, the very thing that had inflated the bubble, evaporated overnight. Suddenly, everyone wanted to sell and nobody wanted to buy. Prices crashed spectacularly, falling by over 90% in just a few weeks. The contracts that were once worth a fortune were now just worthless pieces of paper. Fortunes were wiped out. People who had been rich on paper found themselves in ruin, holding nothing but a few flower bulbs that were now worth less than an onion. The Dutch government tried to intervene, offering to honor contracts at a fraction of their face value, but the damage was done. The trust was gone, and the market had collapsed. So, what can this 400-year-old story teach us today? It shows us that human psychology is a powerful force in financial markets. The same forces that drove tulipmania, greed, the fear of missing out, and the belief in get-rich-quick schemes, are still very much alive today. Think about the recent crazes in certain cryptocurrencies or the frenzy around NFTs. We see the same patterns repeating themselves. An asset with a new, exciting story captures the public's imagination. Prices start to climb, early investors make incredible profits, and the media picks up the story. Suddenly, everyone wants in. People who know very little about the underlying technology or value of the asset start pouring their money in, driven by the hope of astronomical returns. They see charts that only go up and believe they've found the ticket to financial freedom. This is the euphoria phase of a bubble. But just like with the tulips, these bubbles are often disconnected from fundamental value. They are sustained by a constant flow of new money and a shared belief system. When that belief falters, and the sellers outnumber the buyers, the crash can be just as swift and devastating as it was in 17th century Amsterdam. The story of tulipmania is a timeless cautionary tale. It reminds us that markets are not just driven by numbers and data, but by human emotions. It teaches us the importance of understanding what we are investing in, and to be wary of anything that promises easy, guaranteed riches. While technology and the assets may change, the underlying human behavior remains remarkably consistent across centuries. The desire for wealth and the fear of being left behind are powerful motivators. Understanding this history helps us become smarter, more rational investors. It helps us spot the warning signs of a bubble and avoid getting caught up in the madness. History doesn't repeat itself exactly, but it often rhymes. The lessons from the Great Tulip Crash are as relevant in the digital age as they were in the Dutch Golden Age. It's a reminder that true wealth is built through patience, discipline, and understanding, not through chasing frenzies. If you found this story interesting and want to learn more about the psychology of money and markets, make sure to subscribe to Financial Cake for more insights.